Oil prices rebound as Trump exit talk fails to ease Strait of Hormuz supply fears. Oil prices initially dropped on hopes of a U.S. exit from the Iran conflict, but rebounded as the lack of a real resolution brought supply risks back into focus. Ongoing uncertainty around the Strait of Hormuz and continued attacks on energy infrastructure are keeping a strong risk premium in the market. Technical structure remains constructive, with key breakout levels suggesting further upside if resistance zones are cleared. The global energy market is currently caught in a high-stakes paradox. Crude oil prices have staged a defiant rebound, with Brent crude hovering near $106 per barrel and WTI pushing past $100. This resurgence comes despite a flurry of headlines suggesting a potential exit or drawdown of U.S. military focus in certain Middle Eastern theaters. For traders and analysts, the math is simple but grim. Political rhetoric about de-escalation is being systematically drowned out by the physical reality of a throttled Strait of Hormuz. The rhetoric versus the reality. The Trump exit talk refers to the administration's recent signals that the U.S. might pivot away from the direct, costly policing of maritime choke points, urging regional allies and oil-dependent nations in Asia and Europe to take primary responsibility for their own energy security. In theory, a U.S. withdrawal or a finish-the-job mentality should signal the endgame of a conflict. However, the market has interpreted this not as a sign of peace, but as a vacuum of stability. When the world's primary guarantor of maritime security hints at stepping back, the risk premium on oil doesn't vanish, it migrates. Investors are betting that without a dominant stabilizing force, the Strait of Hormuz remains a bottleneck of volatility. Why the Strait of Hormuz still haunts markets. The strait is arguably the most vital 21-mile stretch of water on the planet. Through it flows roughly 20 million barrels per day, about 20% of global oil consumption. The current price rebound is fueled by three critical factors that exit talk has failed to address. The insurance crisis. Even if military strikes cease, shipping companies face astronomical war risk insurance premiums. Many major carriers, including Maersk and Hapag-Lloyd, have already rerouted or suspended transits. A diplomatic exit doesn't instantly lower the cost of moving a barrel of oil through a contested zone. Force majeure declarations. From Iraq to Kuwait, major producers have declared force majeure on contracts because they literally cannot move their product out of the Persian Gulf. As of late March 2026, Gulf oil exports have plummeted by an estimated 60%, dropping from 25 million barrels to roughly 10 million barrels per day. The infrastructure lag. Reports indicate that even if the strait opened tomorrow, the damage to port infrastructure in places like Bahrain and the disruption of shipping schedules would take months to normalize. The geopolitical disconnect. President Trump's recent assertions that the U.S. does not need the Strait of Hormuz due to domestic production, which is on track to rise by 2.4 million barrels per day in 2026, may be factually grounded in terms of U.S. energy independence, but it ignores the interconnectedness of global pricing. Oil is a fungible global commodity. If Asian refineries, which rely on the Middle East for 60 to 80% of their crude, cannot get their supply, they will bid up the price of Brent and WTI from other sources. This bidding war is exactly what is driving the current price rebound. While the U.S. might not need the oil from the strait, its economy is still highly sensitive to the price set by global scarcity. Oil prices dropped after the remarks by Donald Trump that raised hopes of potential U.S. exit from the Iran conflict. The market soon discounted that tensions would subside and supply risks would fall. But that hope was soon lost. The situation on the ground is not improving. Traders are now reassessing whether the conflict is near the end. Therefore, the oil prices are rebounding as the risks return to the market. Oil dropped on exit hopes, but the market questions the reality. The oil prices dropped as traders responded to news that the United States might withdraw from the conflict. The oil market interpreted this news as potential turning point that could reduce geopolitical risk. Therefore, oil prices dropped on lower risk. This decline in oil prices reflected positioning rather than real improvement in supply conditions, as the Strait of Hormuz was still closed. However, market quickly realized that the comments alone do not resolve the ongoing geopolitical conflict. There was no agreement to secure energy flows. The structural resolution has not yet been met, which keeps the risks elevated. Therefore, the initial drop in prices looks more like short-term reaction rather than a shift in the broader trend. Supply risks keep oil supported despite exit signals. The Strait of Hormuz processes 20% of the world's energy and is now the biggest problem for the global economy. If the U.S. withdraws its participation in the war, it is not certain that shipping routes to the Middle East will reopen. This situation keeps the uncertainty high in the energy market. The continued attacks on energy infrastructure keep the risk premium alive in the oil markets. Thus, oil prices surged again on Thursday, following decline on Wednesday. Moreover, the end of the war does not resolve the supply shortages globally in March 2026. The long-term effects of these disruptions on the global economy are huge. The effects will probably be experienced in the coming few weeks. This will likely have the greatest effect on the European economy. If tensions remain prolonged, the flows could tighten the market further. This situation may keep oil prices elevated even if the U.S. exits Iran. WTI crude oil technical analysis. This monthly chart of WTI crude oil, U.S. oil, presents a compelling long-term technical narrative. It illustrates a market transitioning from a multi-decade corrective phase into what appears to be a powerful, momentum-driven breakout. As of April 2026, the price sits at approximately $104.17, having recently surged with a massive plus 50.94% gain from its recent lows. Here is the breakdown of the key technical elements. 1. The multi-year descending channel. The chart is dominated by two primary black trend lines forming a massive descending channel that dates back to the 2008 peak near $150. The support base. The lower trend line has been a floor for nearly 20 years, with major volatility spikes and reversals highlighted in orange circles, notably in 2008, 2016, and the 2020 crash. The pivot point. The recent price action shows a sharp bounce off the channel's midline, median line. This midline acted as a springboard, launching the price toward the upper boundary. The current breakout and momentum. The most striking feature is the current green Marubozu-style candle. This represents a significant breakout above the primary descending resistance line that has capped oil prices for years. The RSI factor. The relative strength index at the bottom has spiked to 70.34. While this enters overbought territory, in the context of a long-term breakout, it signifies extreme bullish commitment rather than an immediate exhaustion signal. Price gap or surge. The label plus 50.94% highlights the velocity of the move, suggesting a fundamental shift in market sentiment or supply and demand dynamics. Key resistance levels, the targets. The analyst has mapped out three critical horizontal red dashed lines that serve as historical psychological and technical barriers. $110 level, the immediate hurdle. The price is currently battling this zone. A sustained monthly close above this would confirm the channel breakout. $125 to $130 zone. This represents the peaks seen during previous volatility spikes, around 2022. It is the secondary target for this bullish run. $150 level, the ultimate blue sky target, representing the all-time highs reached in 2008. Volatility analysis.
The chart explicitly labels volatility spikes at the 2020 lows and the 2022 highs. This suggests that oil is prone to mean reversion moves that are violent and fast. The current move is mimicking the verticality of these previous spikes, indicating that we are in a high volatility regime where price discovery happens rapidly. The technical outlook is decidedly bullish. By successfully defending the channel midline and surging through the primary diagonal resistance, WTI has signaled the end of a long-term bearish cycle. If the $110 level is cleared and held, the technical path points toward the $125 to $130 range, with $150 serving as the long-term objective. However, traders should watch the RSI. While strong, a reading above 70 suggests that while the trend is